Company stock inside of a 401k does not have to get taxed the same way as everything else in that account. A tax advantage exists built to save you money on taxes that you would pay on your company stock. The rule is called net unrealized appreciation, NUA for short. NUA applies only to employer stock inside of a workplace plan, used at the moment that the account gets rolled out of the workplace plan. The common move at retirement: roll the whole 401k into an IRA, company stock included. For a stock that has grown a great deal, the NUA approach makes the most sense. Here's how the NUA works. The cost basis, the original amount paid for the stock inside the plan, gets taxed at regular income tax rates right away. Now, the growth above that amount, the appreciation, gets taxed later at sale. And if that sale is over 1 year, then the long-term capital gains rates apply. It's a meaningful lower rate for most households. A $500,000 block of XYZ company stock, cost basis $25,000, rolled into an IRA and withdrawn as ordinary income at 32%, about $160,000 in taxes. Through NUA instead, pay taxes of $8,000 now, roughly $71,000 later at capital gains rates, about $79,000 in total. More than $80,000 kept compared to leaving the money in your IRA and making distributions later. That stock now sits in a regular brokerage account, not a retirement account. From here, the shares can be held as long as needed. If the stock pays dividends, then those dividends can be used to support income in retirement. Or if not needed, the dividends can be reinvested into the company stock. A bonus benefit I implement with my clients is to generate additional income above the dividend through basic option strategies like covered calls. Now, this is a topic that deserves its own video. In my experience, when someone has worked for their company for many years, it's difficult to sell their company stock, and I get it. That's why holding a portion or all of the stock, collecting dividends, and deciding without pressure counts as a real strategy and not a default decision. My clients prefer to have a choice of when they sell their company stock versus having to sell at required minimum distributions. Company stock inside of a 401k does not have to get taxed the same way as everything else in that account, but the rule only works if used at the right moment, before the rollover is completed and not after. The NUA strategy is worth a conversation and not a guess. Before rolling anything out, let's talk.